Various international retailers, from supermarket giants like Walmart to clothing chains such as Gap, have recently entered the African market, targeting the continent's growing middle class. However, with 54 independent countries, deciding which markets to enter is not an easy decision. Syd Vianello, retail analyst at Nedgroup Securities, joins us in studio to discuss the opportunities and challenges with regards to retail in Africa. Good evening, Syd. Let's start with that. And the name that always comes to mind for me is Shoprite Checkers and Whitey Bisson blazing a trail with his support crew trailing along in the dust, taking action, making decisions and growing market share.
Well, you know, I think what his strategy is first mover advantage. And of course, having been in Africa more than 10 years now, I guess he does in the food sector, he certainly does have first mover advantage. But I think what investors don't realize are the huge challenges that are involved in moving into Africa. We know about the problems with getting goods through customs and stuff lying on the harbour. And I mean, Mr. Bisson, what he spoke about in one of his presentations, where all the fruit and vegetables were rotting. Yeah. And they went rotten because they only cleared the stuff 6 weeks after the container arrived at Luanda port. But that's one part of the story. I heard a wonderful story today from somebody from one of the big clothing retailers about the challenges that they face in moving into certain parts of Africa, without mentioning the names, just to give you some sort of anecdotal evidence, and this is real life experience. This retailer went into Mozambique thinking, well, it's all very simple. We do so well with cellular telephony, selling cell phones or what have you in South Africa. We're just going to open up cell phone stores in Maputo. But only after they'd opened the stores did they discover that the gentlemen from Pakistan, Bangladesh, wherever, are selling cell phones at less than half their retail selling price on the side of the street. Now, whether it's second-hand, whether it's stolen, who knows where it comes from, but the fact is it's freely available to the customer for less than half the price. Mm. But it took them a long time to work that out because presumably they didn't do their homework beforehand. And only after they'd gone and spent all the money setting up the stores did they realize, well, that's the way this market works and the market's not going to change overnight. And that in turn has led them to rethink their strategy for other countries in Africa like Zambia. And no doubt, if that retailer starts moving northwards into West Africa, for instance, and I mean, I can go back, tell you similar stories, not in cellular telephony, but in the furniture industry, for instance, from another retailer that doesn't exist anymore, they may well experience exactly the same issues.
Perhaps that's why the retailer doesn't exist anymore. And maybe what people should do, Chris, is stop talking about Africa. To talk about Africa is like talking about Europe. Well, yes, there's a Eurozone, but you don't invest in Europe. You don't go and sell products in Europe. You sell in Germany or Italy or Portugal. Surely they've got to think of a particular country. Angola is the example that Syd gave.
No, you're quite right. And I mean, if you look at SAB Miller, for example, okay, it's slightly different, but again, you have the same kind of dynamics driving it, consumer demand. They, for example, did an interesting presentation a couple of years ago where they looked at South America, which has 12 countries, 1 Portuguese-speaking and 11 Spanish-speaking, and you compare that with 54 countries, or 53 as it was in those days, in Africa. And what they've done is they've developed an integrated beverage approach, but changing the mix of those beverages depending on which country you're going into. So for Nigeria, for example, you can have the full-on thing with beer, soft drinks, water, mojito, you name it. Whereas in other countries, it might just be one of these things. So you're quite right, David. You have to tailor it. But having said that, I think what Syd's getting at is that the big picture logistics, the difficulty of getting transport into many countries, I think are common to most countries in Africa.
But these are problems which big companies which are clever have the resources, intellectual and financial, to solve. And SAB Miller is one that has. I mean, they were in China and they suddenly realized that the model of big trucks delivering beer is not the way. You need chaps on bicycles with a couple of six-packs because that's the way you get to the outlet that you need. So in terms of investment, Syd, our retailers are supposed to be world class. This was a very bad mistake by this particular retailer, not doing their homework, not checking on the opposition, not checking the price. So an investor doesn't just look at the opportunity, they need evidence that the company involved has done its homework and is agile and acute enough to cope.
Well, I think that may be the reason why the apparel retailers in particular, I think are treading very carefully into Africa. I don't know of any retailer, talking blazonly, we're going to open 50 stores in the next 6 months. I think many of them, the vast majority, are talking about, well, we'll open 2 stores in the next 6 months, and if it works, we'll then try another 2 or 3 stores. Yeah. But nobody is talking about rolling out 100 stores overnight. And I think they will all discover that what works, as Chris said, in beer, what works in Nigeria, may not work in Ghana, even though it's a fairly, sort of neighbouring country, and may certainly not work in Angola.
The smell in the air is not of bryflace, but of burnt fingers. I think lessons have been learnt. Chris, our world-class retailers moving in there, you've often spoken about the Foshinis and the Truworths, and we were talking the other day here, that system of total return. If you had the share price plus dividends reinvested, how would it look? And Anglo-American, for example, 1,000 Rand 10 years ago would have become 1,400 Rand now. Foschini and Truworths are 25,000 Rand over 10 years from 1,000 Rand. Woolworths 21,000. So can they replicate this extraordinary surge of success in going into Africa? Are they wanting to go into Africa, those 3 that I've mentioned?
Oh, absolutely. And look, the one you've missed out there is Mr. Price. Its track record is even better. Yeah. And I spoke to management there recently, and I mean, for example, they go into Nigeria, and you say, well, what's the competition? And they say, well, mango, for example, from the UK, and not much else. So the beauty of Africa at this point in time, and it may not last for too much longer, is that there isn't an awful lot of competition around that, and that's in apparel, it's in food, it's in just about any type of retail you care to mention. So I think South African retailers do have an inbuilt advantage coming from the rest of the continent, recognizing that some of the dynamics we have within South Africa are similar to what you get in the rest of Africa. But as I say, it's not going to last forever, and some of the big boys eventually, well, Walmart's already woken up to the fact, and I think it won't be too long before some others wake up to it.
Syd, which of our retailers are very good at this sort of thing? And I think there might be some overlap between, we've got this curious mixture between a world-class shopping mall, first world type of retail environment, and then you've got deep rural environments with little electricity. Social grants is the basis of income, which they sometimes pool. So our retailers have had to be flexible and adaptable. Which of them are going to be better at this than others?
Well, let's talk about 2 categories. We talk about food and we talk about apparel. Yeah. In the food sector, obviously your first name that springs to mind is Shoprite, and they have seemingly been very successful. Certainly the turnovers have gone up, but if you look at the level of turnover relative to Shoprite's total turnover as a percentage, the figures, the turnover figures, Chris, is about 12% or something, and it's stuck there. It hasn't gone any higher because, ironically, their South African businesses continue to grow at a phenomenal pace at the same time as they've been building Africa. But now we say they've been successful, and they have, and they make money there. Number one, if we go back, let's say 5, 6, 7 years, what I can tell you based on what they told me, there was a huge gap differential between the extremely profitable countries, but unfortunately offset by the extremely unprofitable countries. And I think that's taught them a lesson as well, that whereas we suspect they made insane profits and continue to be very successful in countries like Zambia, for instance, and the BLNC countries, the ones bordering our borders. But there were other countries, Tanzania, Mauritius, Uganda, Malawi, which were extremely, Egypt, of course, which they closed, were extremely unprofitable. Today, I think that gap has narrowed a lot. But now we talk about where is their growth, where is the major growth? It's in West Africa. And we know they're rolling out a lot of stores in Nigeria right now. Clearly, 150 million people is a very exciting prospect, particularly if you can capture a lot of those, those potential customers.
Sounds like you're answering my question with a Shoprite checkers. The one name that hasn't come up is Pick n Pay. We've talked before, Chris, about how Pick n Pay was the blue chip of the sector, and I think you did a calculation when we were at the FM a few years ago of every company on the stock exchange since 1970 until the mid-2000s. Pick n Pay delivered the best return.
Yeah,
it's not there anymore, but. Yeah. It's burnt its fingers in Australia.
I think the problem with Pick n Pay, and I'd love to hear Syd's view on this, is that it sweated the assets too much. It didn't put in. It took an awful lot out, but it didn't put back in. It went back into Australia, cardinal error, made a huge error there. It didn't take cognizance of what the suppliers were saying in terms of they wanted central distribution. They didn't do that. They let Massmart come and eat their lunch in the general merchandising side. They made so many strategic errors, and now what they're having to do is run a marathon at a sprinter's pace to try and catch up.
Pick and pay.
Sadly, what Chris has just said is 100% correct.
Was this on the watch of Sean Summers or Nick Badminton or both?
Well, you know, I guess we've got to go back to the Summers days, because remember, Badminton worked under Summers. So you could argue, well, Summers was certainly part of it. Badminton, who took over, well, he must have been part of it when Summers was there, and then he was part of it when he took over. But you know, the counter argument, of course, is that to what extent was Summers following instructions from the top?
Being Raymond Ackerman.
Exactly. We don't know. To this day, we don't know who ultimately made the call to stay in direct store distribution, DSD, rather than go central. Who made that call? Was it a call of the directors, i.e. the family, that we must maximize dividends and therefore we can't go that route because it's going to cost too much cash? Or was it another call of management saying, well, let's stick with what we've got because we're doing well enough?